been away for 3 weeks in 4 days. I think we arrived on Saturday night. It's Thursday.
I was about to say, I don't know. I'm not sure what the time zone is over there. Is it 2023 where you are?
Yeah, it's 2023. Yep.
Yeah, okay. Just making
Feels
sure.
like 2020, 2019. I don't know. It's 8:30, and you're
It's 10:30 in the morning here.
10:30 Melbourne. Yep.
Yeah.
I kept you waiting a few times this morning.
That's good. That's good. I don't mind the later recording. Because when we record before 9 a.m., things get a bit weird. Last week you said when I asked how you're going, you said I'm solid. This week
Solid.
you said this week you said you're cooked. We're just gonna have to stack up all of these different adjectives. But
then you got me on the Instagrams and the LinkedIn post this week too, didn't you? The cuts.
Pizza. If you haven't already
BTF.
seen it, there's a pizza in. Okay, wait. I'll let Drew explain it. There's a pizza hack. We are grateful that Monique, our producer, when we film in person, she does keep the camera rolling before we actually record, and her favorite part of her day is actually taking the conversations we have before we hit record and then making a bloopers reel. And we've started to release those over the last few weeks, and Drew was lucky enough to have himself featured in a pizza hack. So Drew, can you please tell us about this pizza hack?
That's all. Well, you asked the question: buy, sell, or hold cold pizza.
Yeah, I think it's a buy.
Why would you have cold pizza when there's so many options to reheat it? And then apparently you and Kate have never heard about the most popular reheating of pizza, the method for reheating pizza in the world at the moment.
Is it really?
Been around for at least 10 or 15 years. Yeah.
So tell us, how do you do this? Because I just normally whack it in the microwave.
Yeah, and then it gets. You want me to do the face moves again from the from the post? No. Basically, you get a dry pan. You put pizza in the dry pan. You add water. Then you put a lid on it, and it creates like this proper oven type effect. Because if you put it in an oven, it gets super dry. Put it in the microwave, it gets super soft.
Yeah.
And this gives you a crisp pizza base, and like pizza brand new all over again.
Incredible stuff here on the Australian Investors Podcast. You can learn how to reheat your pizzas if you're interested. But it's actually it's really interesting. I haven't tried
your wardrobe as well.
Yeah, you can check out your wardrobe, do whatever you want. But it's a really interesting hack. So if you do this, please reach out to us and let us know. But the pressing issue of this week is that you have been in LA for most of this week, and right now you're recording from New York City.
That's right.
What on earth have you been doing?
Not a junket.
A junket is
not
what
a junket. No, we came over for future proof. I think we've been talking about this for a while. So some of our what would you say? Some of the people we don't necessarily look up to, but listen to a lot in podcasts. The guys from Ritholtz Wealth Management. So they run the Animal Spirits podcast and the Compound Friends, which are pretty popular in Australia too. And they've done similar to what Jamie and I have done, which is launched an education or a massive advice festival event. We haven't done a festival event, but trying to bring advisors together and build a community of financial advisors. So they had about, I think, 2,500 people on Huntington Beach, basically in a car park you saw some of the photos with not just a car park, with tents and sponsors like Vanguard and Morningstar. There were probably like 1,500 advisors there. We caught up with Matt Middleton, so the founder of, it's called Advisor Circle, and this is called Future Proof. And his intention is to get something like 10,000 people there, I think within 5 years. So very new concept. So live podcasting, which we're well aware of. Hopefully I'm not in the footage anywhere. Open bars, like the bars opened at these stalls from about 12 o'clock onwards or 1 o'clock, 12 p.m. or 12 noon, sorry. This is probably one of the highlights there was this, and they're saying quite proprietary, which is this one-on-one networking. So you can have pre-screened one-on-one 15-minute meetings throughout about 6-hour blocks during the event, which was quite unique. And then obviously Method Man and Red Man.
Method Man and Red Man presenting. They got everyone, all the financial advisors in the crowd doing the whole everybody in 313 from Eminem 8 Mile days, going a bit nuts in the mosh pit up the front. So I don't think I
was
ever
gone by then. Let's just disclose that. I was already home.
Okay, so I wouldn't have ever thought that you'd see all of these mostly middle-aged men and women from finance getting down with Method Man and Red Man.
I think it's just something about the age group though. So if you think the founders of Ritholtz are all like in their late 30s, early 40s,
Yeah,
and it's just those bands that were popular at the time. So they'd like, is it G Love and Special Sauce?
yeah.
And I'm sure that's just one of their favorite bands. So it was just, and like we talk about the same old jokes on our podcast all the time.
Yeah. Yeah, fair enough.
Same
And so
era, just matches what's happening at the time.
So did you do that speed dating thing where you like sit down for 15 minutes with another financial advisor?
Or is that because no one asked me to? I didn't get any requests. Jamie had quite a few, so we did like a 2-on-1. I just crashed a few of his.
Yeah.
So there were heaps of fund managers there, small, big, private equity, public markets. And a financial advisor from Australia who's running a firm in London, which was pretty interesting. I think it was one of the only Aussies there. It was super interesting format. And then asked a few groups. We've talked about Betterment and Wealthfront and these sort of groups before, and asked about their intentions to come to Australia.
What was the answer?
What do you think?
No.
Hard no. Don't look forward to it. So start making other plans.
So Betterment and Wealthfront, just for people that aren't aware, are like true big robo-advice platforms. They actually do. Yeah, they actually do what they say. They're not like these Australian quote unquote robo-advisors. They're actual robo-advisors. Like they do behavioral finance within the app. For example, it will stop you from making a decision based on what they believe would most likely result in, for example, tax losses based on emotional decision making and these types of things. Like they're truly advanced platforms. Did you catch up with the CEO of the former CEO of Wealthfront?
Yeah, is that Adam Nash? Yeah, I had a quick chat to him on I can't remember which in the afternoon. He's founded a group called Daffy, which is like micro investing into philanthropy. So like micro donations and kind of rounding up your coffee order and putting it towards a donation every year. Cool. That was interesting. Good to understand what's happening in the US market. And we talked about this, the advisor circle and Inside Network and Rask and Waddle are all about building communities, aren't they? So, and that's what you kind of saw at Future Proof. There's no real leader. Like there wasn't someone hosting every session. There was very much, which was a pro and a con of the whole thing, which was there's nowhere you had to be at any given time to hear what was happening. It was a bit of a mix and a blend. That's kind of the difference communities and associations, isn't it? Where there's no true leader. It's the group that determines what happens.
Was it did Morgan Housel kind of in a way kind of headlined with, did you get the chance to see him on stage?
We missed him on night one. I think we were either late or headed off early. He had a session hosted on night one. I did see Animal Spirits live and Compound live.
Yeah, cool.
Which were good.
That would have been like the ultimate fangirl moment for you.
I had the chance to get my selfie and I didn't do it. I'll regret it forever.
I thought you might have like pulled down your shirt and got him to like sign your chest or something.
I went close. I mean, Ben Carlson walked past me like 15 times. I just, should just ask. You kind of want both, not just one of them.
Ben, if you're listening. But that's great, mate. Shorter in person. Never meet your hero.
I'm not tall.
That's good. So obviously we got a lot of questions sent through this week, and so we'll try and get to those in a moment. But just a reminder for anyone that's watching or listening, general financial advice rules apply. We don't know your personal circumstances, your needs, goals, objectives. So as always, consult a licensed and trusted financial professional, like say Drew here from Waddle Partners Financial Planning. There's a link in the show notes. So next week, actually, the time that we record this next week, I'll probably be on the road, or actually maybe back in this very seat. Who knows, actually. I don't know if I'll still be in Sydney at this time or not, but we're going to Newcastle next week. I don't think you're coming to Newcastle from memory, but you will be in Sydney. I think Renato's stepping in for you, the Honourable Renato.
Yeah, I think I'm getting back Tuesday morning, so...
If you're in Newcastle, if you're in Port Macquarie, we've turned Port Macquarie into a bit of a dinner, but Newcastle, the Rask Roadshow is coming up this week. So Newcastle, if you're in or around Newcastle, get there. We're going to have, obviously I'll be there, Kate will be there. I think we're going to have Pete Wargent. I think we're going to have Chris Bates. There'll be the Global X team. There will be Glenn James, Declan, who's a fantastic, like a behavioral psychology professional. So many good people. Shelley from My Millennial Money. So many great acts coming up in Newcastle before the big event, the big roast in Sydney on the 3rd of October. We're also hosting a Value Investors workshop, which is something I haven't done for 3 years, Drew. And Mel was like, well, you're in Sydney. Let's give it a crack. So I'm going to do a day-long intensive session for anyone that is not an absolute beginner investor, but you want to actually understand how to value companies, how to assess management, how to properly interpret financial statements, avoid risks, and how to invest in like fast-growing companies, basically. We're going to cover all that. And Magellan is going to be our host. So we are hosting the Value Investing Workshop, an 8-hour intensive session with me. Maximum 15 people, probably more like 10 people in Sydney, the day after the event in Sydney. So this is on Wednesday, the 4th of October. If you come along to the event, you get about $600 worth of goodies, which include passes to the Sydney event, the roadshow. You get merch, you get books, you get a membership through Rask. And we're also going to quiz a fund manager live on the day. So it's going to be heaps of fun. You get to network. There'll be a link in the show notes saying Value Investor Workshop. It's $799. And we actually did get a question through this week from Simon, who asked, he's interested in coming to it, but would it be tax deductible? And Drew and I were both trying to figure out if an 8-hour session to a value investing workshop, which, quote, focuses on income, end quote, would be tax deductible. I feel like this is one of those gray areas where if you have a deductible expense, it has to be in the pursuit of more income. That's my
exactly. Yeah, for an expense to be deductible, it has to be a helping you produce more assessable income, and that would be generally in your personal name or in your, to deduct in your personal name. You want the income in your personal name. So I mean, people pay for subscriptions or trading programs and claim tax deductions, but I think it's I don't know if there's a hard line that says this isn't, this isn't. Lots of interpretation by your accountant and yourself.
So maybe just check with your accountant if you are interested in coming to that event. I know a lot of people do go ahead and claim our Value Investor program, which is the online version. They are always writing in asking for tax receipts. But yeah, just check it out. I know last time I did one of these sessions in Sydney, we sold out with about 20 people. This was before COVID. And a lot of people in the room were actually portfolio managers or analysts. It was really surprised me, actually. I was there teaching value investing. This kid from the block, and the fund managers were rocking up, and they were using, as their bosses paid for it, or they did it as CPD. So come along. Sydney is I'm only going to do one this year because it actually takes a lot out of me to do them. But it's a great day. I love to network. I actually ended up hiring an analyst from this program as well, and I know a couple of others actually got a job in industry. So there's that. The other thing was I did a survey during the week, Drew, ahead of a launch of something that we're working on, which will go live next month. But interestingly, I'm going to throw some data at you. As of right at this very second that we're recording this, we've had 1,064 people respond to this survey. I thought maybe we'll get a couple hundred. So it's been a lot to go through, and I promised to go through all of the responses.
It's not about pizza, is it?
It's not about pizza. But this is some of the responses. So I asked people, which was really interesting. We have more people in their 70s that subscribe and listen to us than in their 20s. Now, a lot of people that respond to surveys are probably not in their 20s. They're probably doing other things. But it gives you a sense of like, this audience is a lot older. So we got to probably reframe our jokes. Like if we can't have Taylor Swift maybe on the show. We need to have like, I don't even know an artist that would be relevant to
Rolling Stones.
Rolling Stones. There you go. Metallica, the Beatles. Yeah, so we've got a lot of people that the average age is set.
What are the percentages there?
So the percentage is, I can bring this up on the screen actually. So for anyone that's watching on YouTube,
always showing off.
What the tech? I'm just figuring this out as we go. But yeah, we have more people in their 70s, and the biggest bulge bracket for people in the Rask network are in their 40s. The next question, which was quite interesting, and by the way, if you haven't filled out this survey, please do me a favor. I would love it if you did. The link is available in your show notes. But which of these best describes your investing focus right now? And I wanted to find out, do people just invest in ETFs? Do they just invest in index funds? And I gave them 3 choices. And I said, one is you'll only ever invest in ETFs. And about 5% of the audience say they only ever invest in ETFs. Someone says that the next group was, I currently invest in ETFs, but I want to go beyond that. That was 16.5% of people say they want to go beyond just ETFs. And 78.5% of people say they already invest beyond ETFs and other things like shares, property, LICs, REITs, etc., managed funds. So basically, I would assume for the Australian Investors Podcast, Drew, that it would probably be higher than this. I would say it'd be about 90% of people invest in things other than just passive investment.
Oh, this is for the whole audience, yeah.
Yeah, this was just for the newsletter and the membership.
Yeah.
But anyone that I've opened it up now to anyone who wants to take the survey, please, there's a link in your show notes. The feedback actually does help us design and get better at things. But I don't know. I guess that caught me off guard, Drew, because I just thought maybe 2 things. I thought the Rask community was younger. I also just thought maybe I knew that they weren't young like Equity Mates, I assume, or She's on the Money community. I assumed it was more like the Motley Fool or Morningstar community, but this is probably older than I thought. So I don't know if what do you think? But
credit to you. I mean,
oh Jesus!
When there's
one day in New York, and here he goes.
Well, one of the interesting things about the Ritholtz is that how many financial advisors actually listen to their podcast, as well as retail investors, which is probably similar to what's happening here. Is that not to brag, but I think the content slips between incredibly detailed and more basic high level concepts. So it's the ability to do both, which means I think it's must be skewing the audience.
Yeah, I agree. And we haven't done one of these recently, but a good question to ask in the future would be like, are you a finance professional? And in the past, when we've done this, I think it's about 6% of people who listen to this show that we're on right now are finance professionals. So 1 in every 20 is working in our industry. But this was the next thing that was quite interesting, was the makeup of portfolios. Obviously, we've got about 22% of people who say that their investable portfolio is under 50 grand. But the skew to bigger balances is incredible. So currently across the Rask network, as of August, I did the numbers, we have 173,000 unique listeners. And what was really interesting with this is, so this is only based on about 1,000 responses. Around 1% of the audience has $10 million or more to invest right now. Nearly 10% are between that 2.5 mil and 10 mil. And then at 14% for 1 to 2.5, 14% for 500,000 to $1 million, 15% or 14% for 250 to 500K. And so this is excluding people's primary residence. I made that very clear in the survey, but it actually skews to quite large balances. And the average balance, the mean average balance is around about 640,000, excluding that 10 million, because you never know who puts in 10 mil. They might have $10 and they put in 10 mil.
Could be in crypto. You never know.
Just a couple of lords.
10 mil.
Yeah, but I don't know. All this information kind of caught me off guard.
Very, very interesting.
Yeah. For us, it is. Maybe everyone listening is like, "What the hell are you guys talking about?" But there was a couple of people. So even though we have a very small sample size, under 30, because our audience isn't that young. I'm sure if Kate did this on the finance podcast, there would be a bigger audience in the younger bracket. But a few of them have either received inheritances or have come into money or made a lot of money. And around 3% have report as having $2.5 million in investable assets. That's for under 30s. So there are some really young people that have come into a lot of money, and that's a lot of responsibility for folks. So make sure you get the right advice. But one final thing that I'll throw out is the preferences of people, Drew. So I'll see if I can get this up for you on the screen as well. That's not it, and I don't have it in front of me. But basically the preference is, and this will be really relevant to you, obviously, as a financial advisor who specializes in retirement, mate. The number one thing, obviously, on people's mind is retirement. At around 30, it was about 36%, I think, off the top of my head. But then the next most important thing is this idea of financial independence. Now, this idea is really big, but the FIRE community, which we know only appeals to around 2.2% of people. Investing for kids was about 5 times more commonly mentioned as a goal. So whether it's grandkids or kids, and passive income was around 20% of the audience. That's the number one reason they're investing. So what it basically means is like retirement is obviously the number one goal. So you're in the right place for that. But then I would say passive income is the next most important thing. So anyway,
that's very, very closely related to passive income and retirement.
Oh, absolutely, and they're all intertwined, aren't they? Like if you're going for retirement, or you want passive income. So I just thought, yeah, it was a really interesting survey, and if you haven't already taken it, all the results are made public, so you can jump in there and have a look. But yeah, I just thought it was really interesting, mate, because what it tells me is that our audience is very, very sophisticated. And it also tells me, actually, here's a fun one for you. 270 people from Sydney took the survey, but we haven't sold 270 tickets. So if you're listening to this, get to Sydney, get to the event in Sydney where we're all going to be, and we would love to meet you. It's only 40 bucks.
How many tickets have you sold?
Sydney's actually underperformed what I thought I would, but we've sold about 170 so far. Keep in mind,
I love a crowd, so
yeah, Drew's up stage sweating.
Love a crowd.
Is that a see-through shirt, Drew?
It was.
Oh, no, it's white. But seriously, Sydney's going to be big because obviously there'll be the two of us. Jamie will be there. There's going to be so many great guests. Obviously, Kate. We're going to have Queenie. We're going to have the team from Perla. We've got Chris Bates, Pete Wargent, Amy Lenardi, Evan Lucas. We've got Global X. We've got Magellan there. Such a great crowd. So please come along to that if you're in town, and bring your friends, bring your family. Use the coupon code FRIENDS, plural friends, because you'll get like 33% off the tickets. So some people have bought like 5 tickets. So maybe there are more than 170 sold. I don't know. But anyway, I've got some hypotheticals, Drew, for you before we get into the actual questions from the folks. I
haven't prepped these at all though, so be warned.
Okay, here we go. So 3 things you have learned in LA, or like on your junket in America. What are the 3 things that you have learned so far?
3 things. I think that the US is incredibly focused in financial services on the client or the user experience, significantly more than Australia, and a lot more progressed.
Yep.
You know, like to the point of what happens. I think you do it quite a lot, not just in your podcast, but on your website and everything. What happens when you click this? What's the experience of going through this process? And when you join, and the part of that's automation, part of that's experience. So that was probably one of the big takeaways. There's a lot of talk about that.
For sure.
I've got a funny one in there. Texas has a product or an outcome for everyone. So there was Texas ETFs, and they just issued Texas only ETFs. So diversified Texan companies. That was. I got a really. Actually, I can have a fourth. I've got to pull up a third one first.
Yeah, go for it.
I think in terms of, we've talked about direct indexing before, which in hindsight is quite similar to our own managed accounts, if you know how managed accounts work.
Mm-hmm.
So managed discretionary accounts offer an advisor or a professional investor the ability to have discretion over how they build and manage a portfolio for you. What's popular here is saying, I want the S&P, but I don't want Apple, or I want the S&P, I don't want oil. And they call that direct indexing or true indexing.
Mm-hmm.
And then
that's super fast growing. That's about 400. I think it's $460 billion in direct indexing in the United States. Yeah.
And then by the way, managed accounts.
Yeah. And by the way, Texas has higher GDP than Australia. So
yeah,
I just had to confirm
they told us that. They confirmed that with this. And then there's this SMA versus ETF thing. So SMAs being like fund of funds, or the way we look at them as multi-manager almost.
Yeah.
And there's a lot of ETF issuance over here. So instead of launching an SMA, some financial advice groups are launching ETFs.
I think that's where it's going to go, right? Like if you have a really good so just so people know, an SMA is like if you go to a financial advisor and they put together a portfolio for you, that portfolio is still in your name, but so you control it. You have ownership of the underlying assets. Whereas when you invest in an ETF, you just get the units. So the ETF manager controls what happens inside it. Similar to the financial advisor, but the difference is that you own the underlying assets in an SMA.
Yeah.
And that means that it's better for tax reasons.
And
but
direct indexing is the same, that you can control the tax implications, whereas an ETF, a fund, everything else, it's just a pass-through entity.
Yeah. So
The last one was basically I didn't realize how humid it was in California, and I wore chinos and a shirt to the beach. That's the final lesson.
Don't wear chinos.
Don't wear chinos and a shirt to the beach in humidity. I chose white at least. So
okay, so Texas has. Let's just recap these. Texas has something for everything. User experience is much more important to financial people in the United States. The other one was direct indexing is really, really important, and don't wear chinos on the beach. Okay, got it. That's some pretty good insights. And I think, especially on that user experience thing, let's just be honest. A lot of the financial advice world in Australia is just so clapped out and old looking and functionally depleted. Even the platforms themselves aren't accessible to individual investors as easily as they should be. The regulation in Australia makes it so hard for tech companies to innovate in our space. And that's been a huge problem since the get-go. And that's why there's that's why I have a gripe with innovation, with regulation in our sector. I think it's good, but I also think it just means it's almost impossible to innovate, and incumbents win. So the second hypothetical for you, Mr. Deremith, is I want to know what your biggest ever winner is, but also what you learned from that.
Biggest, I think, did we talk about the trade desk last time? Can I go over? I mean, you could say FANG, but that was only 100% in only 10 months. So yeah, it's not quite up there. I mean, the business, if you talk about winners, it'd be the bar, but I don't think we want to do private markets. There's no valuation on that. It just spits out income.
So this is the bar that Drew and Jamie and a few other folks own in Melbourne called Beneath Driver Lane. Get there. Good whiskey. Go on.
That's an example of where you're getting twice your investment back every year. That'd be, whether you can value that income stream or not, it's another story.
Yeah.
But trade desk, you can discount anything, can't you? Couponize anything and start selling off shares. Trade desk. So I think I mentioned this in a couple of the roadshow sessions, with a gag on how I got that White Lotus shirt.
Yep.
Trade desk does programmatic advertising. So, middle-aged white man that watches White Lotus scrolling Instagram, and they send me an ad that has a cool shirt in it that I don't realize will take 8 months to get delivered. I think I'm up 600-700% on that. So it's nothing, it's not Pilbara or CSL.
Yep.
Or anything. I mean, there's still probably a couple of lessons. Yeah. Position size, like you could have gone harder, and then sometimes compounding, and it sold off pretty heavily in COVID, but is still doing pretty well since. Reminds you not to sell your good stuff. Always have patience, because at some point you want to start. You think about selling off. Even people, even so-called, I shouldn't say
air quotes,
professionals. I've never done that before. Professional investors get the same tendency to say, particularly with my own money, I need to, protect the bottom here, but didn't. So, sticking through the volatility and holding on to companies, and if they're good companies, letting them continue compounding.
Yeah, it's a good lesson to learn.
And yours?
I might do mine. I'll do mine after this, because they're actually very much related. So your biggest winner is the trade desk, which is programmatic advertising, helping put ads on websites, in your Netflix, in your Apple TV, whatever, like where you got connected TV, they put ads on there, and on your podcast too, by the way.
It's like a platform that allows advertisers to pick and choose, so it's more transparent, I think.
Yeah, and it's programmatic, meaning that it automatically chooses the most cost-effective place to serve ads. Okay, so if that was your biggest winner, being the trade desk, what is your biggest loser?
We mentioned, I think we did this one a week or two ago. There's a couple. We've all had a few. There was Forge Group, or
Forge Group that went out of business.
We discussed this on the finance podcast, maybe.
Maybe.
Yeah, it was an engineering company in a reasonably good market for engineering, but bought, and within 3 weeks, the fixed price contracts had run completely over, to the point that all the equity in the company was wiped out, and they went into administration. And that was like a lesson that, as much due diligence as you can do into the financial statements of a listed company, there can always be something hidden. If there's a lesson, I mean, applied more to clients, is you just don't step outside the highly researched. If there's 2 or 3 analysts, it's not enough. You want 8 or 10 analysts if you're looking for this kind of retirement, quality, boring, diversified cash flow.
Yeah, we'll get to that in a second. There's actually a question on that. But my biggest winner, so Pro Medicus and all that have been and Apple and all those types of businesses have made me the most money. But this was really interesting. I wrote about this years ago when I was back working for the Motley Fool. I wrote about a company called LNG Limited. Liquefied Natural Gas Limited was the company. The ticker symbol was LNG. Who would have guessed it? And this company was creating a port, like a port in America, actually. And what it was doing is it would take the gas and make it liquefied natural gas. And then it would be in this port or terminal. It would then take that onto a ship, put that on a ship, and it would go to Asia or wherever they were selling the gas. And interestingly, so this business was trading at about 29 cents when I came across it. And within about 10 months, it got to $5. And so I only put about $2,000 to $2,500 into this thing, early days for myself. And it got to 25 grand or thereabouts in 10 months. And so it was a huge winner for me early on in my investing. And I sold a fair bit. Like I sold a fair bit at 5, and then I sold a fair bit about 4, and I got out. Later, that company went bust. I've heard stories of folks who have lost a couple $100 grand trying to think that this thing might turn around. But what was really interesting is like Seth Klarman's business got involved in it, and so many other investors got involved in it, and it hadn't even got off the ground yet. The reason why it went crazy is because this is at the time when LNG was all this, the rage about the world of energy, solving the energy crisis and all this sort of stuff. But what happened is Cheniere Energy, which some people listening to this would know, Cheniere Energy in the United States was just going gangbusters. And then people were like, well, what's the next thing that is like an infrastructure kind of play that's positioned to benefit from this huge rush? And it was this business. So international investors got involved in it. And anyway, I remember catching up with someone who did lose a bit of money in this company a few years later, and he attended and spoke to management and said, how are things going? Blah, 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 blah. And they were great. They're saying it's fantastic. Everything's fine. We're on track to make this project work. And so he tipped in more money. And then within 6 weeks, it filed for bankruptcy. And the lesson for me from this was that luck can play a big role in your investing and you don't realize. And for me in particular, I was just completely lucky. This was a 100% speculative investment. I didn't know, there was no, other than knowing what the business does and some of the competitors and who's done what in the industry, the only reason the share price went up was because other investors piled in thinking that it could be the next big thing. There was no skill really beyond that. And then that was my biggest winner. And it basically taught me the value of being humble on the way up. But on the way down, I actually took all of that money and I started buying warrants. And I ended up buying warrants. So warrants are like options contracts, if people are familiar, except they're leverage. They've got embedded leverage in them. So you might buy like one warrant and it's got exposure to, say, 50 Rio Tinto shares or something.
Telstra was issued that way.
Yeah, exactly. And this is what I did. And I put all of my money basically into Rio Tinto and QBE warrants. And within 5 months, I'd lost all the money.
Sorry, should laugh.
And so this was just an example of, I wasn't humble enough on the way up, and I thought, well, I could take more risk for more return and see what I could actually do here. And on the way down, I got into things that I just couldn't understand, and I just got like way ahead of myself, and I just lost it all basically. And it was a really roller coaster of a ride. And I think the big lesson for me is the importance of kind of like knowing your emotions and keeping yourself in check as best you possibly can. And that was one of the lessons. Okay, so this week we've got a few questions sent through. We'll try and scoot through them, Drew, because I know you got to get to dinner over there in NYC. It never sleeps, that city, but I know you got to get to dinner.
I try to.
We do a call for your questions. There is a link in your podcast player that says ask a question. Select the Australian Investors Podcast. It's really that simple, and we'll give a crack at your question. We can only answer generally speaking, and that's why we always call for a funny name when you send your question in. And every week we award the funniest questioner name a prize, which is the Value Investor Program on Rask Education, $700 dues. Oh no, so $500, sorry, nowadays for you for free, if you just write into us if your question is named number 1. See a financial advisor, like say Drew here, if you need professional advice, and that would be a great idea. The first question was a text that I sent through to you this morning, Drew. I'm just going to try and get it up on my phone really quickly. But basically, the question was along the lines of, here it is. It was from Nathan, who sent in a question. Not a very creative name, Nathan, but that's okay, mate. Won't hold that against you. Nathan sent in a question that said, "Hi, Rask team. A question for the Australian Investors Podcast. In a recent podcast, Drew mentioned that in their equities portfolios at Waddle, they use direct equities for their Australian equity exposure. Could Drew elaborate on this and also touch on the benefits? Thanks, guys. Keep up the good work." Thanks, Nathan. That's a great question. Why do you, instead of using, say, like ETFs or managed funds or this, why do you have individual shares in the portfolio for Waddle clients?
There's a few reasons, and the normal answer is it depends.
Oh, gosh.
Cue laughter. Sorry, don't have a laugh button today. I mean, one is it does depend on the risk profile of the person, and in our experience, a lot of people actually come with direct share portfolios when they come to us. So most retirees have built shares, got an SMSF already, so they've already holding these things.
Right.
And one part is it's incredibly difficult to convince people to give up on that and sell all of that and go into ETFs or funds that are kind of non-impersonal, if that makes sense. We like to bring some less personal connection. So one is just the incumbency of those holdings, but two, incredibly cheap, like, investing in stocks directly. You're not paying a management fee, whether that's to an ETF or a fund more broadly. And you can control where your exposures sit. In referring to the first part, you can control your tax position at the same time. So if your CSL weightings overweight, you're not forced to rebalance it during a financial year. You can always wait and do it in the next fund. You can control the CGT events, and then manage. We think for a lot of clients where they're comfortable with that high level of volatility, you can replicate the ASX because and even replicate in a slightly better way by doing it directly. So we try and have 15 to 20 equally weighted holdings that don't go outside the ASX 200, and you have a similar exposure to financials, but it's more diversified than the benchmark, and similar exposure to materials, but it's more diversified, which has its ups and downs. So if you think active share, which is how different our portfolios would be from the index, it'd be significant, and just equally weighting versus the index, which is market cap weighted, means you have a completely different outcome. And it's tended to, I think equal weightings tended to work pretty well for the last 5 or 10 years.
And that's a really good point you touch on, is that you deal with clients one-on-one. So like everyone's portfolio is a little bit different, even though there might be like the general model that you guys follow and research with the team. But that's really important because you might have someone that's done really well with CommBank, CSL, BHP over the last 30 years. They've got $500,000 in those 3 shares. Why would you go and sell them straight away if there's no reason to? Might incur like tax or whatever. But also if you have the larger balances, which a lot of the Waddle partners clients have, 3, 5, 10, $20 million, it would make sense that you have a direct equities portfolio because it may even be cheaper once tax and fees is taken into account too. Obviously it's a bit more work on your end, but how do you go about, so if you do run a direct equities portfolio, how do you go about finding the companies? Just generally speaking, obviously we could spend an entire podcast on this, but just what are the kind of things that you're looking for?
We had a similar question on the roadshow, which is given what our intentions are, which is we see our exposure to Australia versus global as being income focused and kind of back, call it cyclical or value. So looking for cheaper companies, and that's just the nature of the Australian economy. I know you found some good growth companies in Australia, but they're a lot more rare and tend to be a lot more expensive in Australia. So that naturally goes towards more of the old-fashioned businesses in Australia. We barely stray outside the ASX 100 and rely on heaps of research, but basically we just want companies that are, like anyone, consistently growing earnings and less cyclical.
Yeah, that makes a lot of sense.
Generally, we don't have like a fix. We want 4% dividend yield or higher. We're probably more wary of ensuring we have at least 1 and a maximum of, say, 3 exposures to any sector. So making sure you've got good economic diversification in your portfolio.
Yeah, fair enough. And to be honest, it like I said, it does make more sense the bigger the balances and the more individual the clientele to do that. So I'm actually going to go to the next question now. That's a good question from Nathan. Thanks for writing into us, Nathan. Don't forget you can use the link in your podcast player rather than sending an email. So Over the Hedge writes in and says, stellar yarn last Saturday. The pod about hedging was not something I had really considered. I liked Drew's comment regarding having portfolios that perform in any market scenario. Could you expand on that? There's a lot of people saying, can you expand on certain things, Drew? And if I've got a few decades till I retire, should I be concerned about the current weakness of the dollar in the short term? Now, just over the hedge, obviously we don't know your personal circumstances, but just generally speaking, Drew, you did say about having portfolios that can perform in any environment. First of all, can you tell me what that means? And second of all, how do you think about currency? And then I'll have a bit of a yarn as well.
I'll try. I'm a bit under pressure today. Little preparation, but I mean it's something that's close to our heart, and I think part of this comes back that we focus on retirement. So you got a finite pool of capital. You want to make sure that if the consensus, say everyone's expecting a recession, is wrong, you're not going to be worse off as a result. And we found that the consensus. We read the papers and we all assume that what the papers are saying is true. That we'll have a recession, that unemployment will go up, the property market will crash, and we assume that's true. But there's a multitude of potential outcomes, and what we're saying, an example could be there's a prediction that if you say interest rates will go higher, interest rates will stay where they are, and interest rates will fall, different assets will perform incredibly differently in each of those environments. And we want to have a reasonable bet in each camp to make sure our clients aren't overexposed to one or not exposed to one at all. And a lot of this comes down to actually understanding what holdings, what your investments are actually most most correlated to. So like no one at all in the last 2 or 3 years. I mean, a lot of people had a lot of growth companies in their portfolio, or a lot of global growth funds or global growth ETFs or thematic ETFs, and the biggest influence on the value of tech and growth companies was bond yields. And bond yields were at 0 to 1%. Now they're at 4 to 5%. That's one of the big key drivers of growth stocks and tech companies falling off significantly. That was a long answer.
Oh, I like it because while you're doing that, I was actually just doing some numbers, which are going to answer the next question. How's this? Just doing some quantitative stuff on the fly here at the Australian Investors Podcast. But yeah, we were reviewing this, and I've been reviewing this a lot lately around currency hedging. And one of the things we spoke about was currency hedging is actually one of those areas where it's kind of like there's like this void that sits between all this logic and reason here in Australia, and then you go through this void where it's just like this big cloud of unknown guesswork, and then on the other side you've got foreign markets, and people like venture through, and then they come out the other side, they're like, I don't know, I just kind of made it through. And so like everyone has a different policy when it comes to hedging, right? Like we did just a bit of Googling before this, and we found that like for the Australian Super Fund, they basically have a set amount of that portfolio that is allowed to be exposed to a foreign currency. So, for example, in their balance strategy, they allow 20.5% of that portfolio to be exposed to foreign currencies. And you made the point before that off air to me that, say, Australian Super has a 60-40 portfolio. If they're saying that 20% of their portfolio is allowed to be exposed to foreign currency, that's probably around about half of that 60-40. You know? So they're basically cutting in half their overseas exposure, so half hedged, half unhedged, which is a pretty simple way to look at it. And then the Future Fund, in their currency note, this is from 2021, it says, we explicitly manage the size and composition of the currency exposures in the portfolio, rather than them being shaped by the underlying investment. So they actually take an active stance on currency. As at June 30th, 2021, we held an exposure to foreign developed market currencies equivalent to 32%. So basically what both of them are saying, the big capital allocators in the room are basically saying about 20 to 30% of our portfolio is exposed to foreign currencies. And that's maybe a yardstick that other people can take. But then there was one other, which is what I know we were speaking about off air. When you take the full Australian dollar over the long term, it is smashing right through that lower bound on the kind of two standard deviation. So if you are thinking about currency, now is the time to think about it. But I did do some number crunching early on, and we did have a quick look at this. The average level for the Australian dollar since the year 2000 until today is 77 cents, We are currently at 64 cents. So we are quite a way away from the average. There have been times when it's been above parity, like it's been over $1.
120 at some point.
Yeah. So it can swing around wildly, but at the moment it would seem kind of the opposite is true for us, that now we're at a point where maybe the odds are tilting back the other way.
It trends a lot though. That's why the rule isn't perfect, but it is an incredibly good trigger to review and start thinking about doing something about it. And that could just be, if we're making a change in our next quarterly review, it might be that the next edition is a hedged global equity or a hedged S&P 500 ETF rather than topping up the S&P 500 ETF that's underweight, if that makes sense. Not that we're recommending that, but it could just be the incremental change, and you've naturally got an issue. If you've done incredibly well in unhedged as the dollar's fallen, well, you've probably got a capital gain you have to worry about too.
Yeah. And I think for accumulators, that's the big challenge, right? In a retirees portfolio, zero tax environment, you might be like, well, okay, yeah, we'll just switch across. But it's basically, as you said, those incremental dollars you might start swapping across now. You do pay extra for hedged products, by the way. For example, you mentioned the S&P 500. The iShares one is the most common one. That's IVV. That's about 0.04% in management fees. You go to the hedged version, it's about 0.1. So more than double the fee load, even though it's still very small, very, very small. You pay more. So there was an interesting question that came through next from Akfil Sikdal.
Don't do the Phil one. Okay. Never do a name that starts with Phil.
Okay, never.
There's one rule in life.
If your name starts with Phil, don't use your name when you write into us, because your question and name won't get read out. But Phil, yours might come up soon. Anyway, Arkfil
Sikdal.
Yeah. Okay, so Arkfil says, just wondering what is happening with RPM Global. Ticker symbol RUL. It has fallen 7% this month following good results. Thanks, lads. So while Drew was talking about currency and portfolio positioning and all that sort of stuff, I was just doing a quick jump into my old, I'm going to rename this sheet RPM Global. And I was doing this on the fly. So this is what I've come up with. I've just got some data, and anyone watching this can see it on YouTube. If you haven't already subscribed to Rask YouTube, get on it. I actually pulled up the share price of RPM Global since January 1st, 2015, and I got the daily share prices, and I was trying to figure out how many times has RPM Global risen more than 5% or fallen more than 5%. It has fallen more than 5% 75 times in that time, and it has risen more than 5% 68 times. So if we're just thinking about a small or mid-sized Australian technology company, very impressive company, growing pretty well, what it basically says is strap in, because this is small cap investing.
This is why we, if we're doing for retirees, we'd never stray outside. I mean, this is probably still top 200, but maybe outside the 100.
Just outside the 200, I think. Yeah.
That's just it's incredibly difficult to get an edge, and you have to be comfortable with this huge level of volatility. And it can be more difficult to make decisions unless you're truly in it for the long term, and then the benefits can be there.
Yeah, I'd love to have Richard Matthews, who's the CEO of this company, on the show. It'd be really insightful, so I might reach out to him. But yeah, I mean, that just gives you an illustration, and you can see it in the share price chart. RPM Global, which is selling software to mining companies, a really impressive company, good founder alignment, owner-operator alignment. It shows you that in order to invest in companies that are really impressive, you have to take maximum volatility, basically. And so the company's share price has risen from 34 cents in 2016 up to what it is now. It's about $1.60. So it's like for folks that have held it for that long, it's six bagger. But what's really interesting is I was doing some reading the other day. Lachlan Berg-Jensen, who I know sent in an article to us the other day, and he found out that Apple is one of the best performing companies over the past 30 years, no doubt. Created, I think, the second or third most value of any company in the world over the past 25 years. But in that time, it has had 3 70% drawdowns. So a company that is probably the best performing in the world has had 3 moments in its history where it has fallen from its high of more than 70%. And this is not a rule that holds true for every company. Like, don't just go out and pick the company that's fallen the most and think that's a good investment. But it is true that if you want to make money in this world, you have to take risk. And I think what's the old saying from Hans Rosling? Things can be bad and getting better. So things can seem bad at the moment, but they can be longer term getting better. And I think that's a great phrase for describing this style of investing. All right, Drew, we've got a couple more minutes. I'm just going to answer these. We're going to get to these questions really quickly. So Tikr says, what are the pros and cons of using Simply Wall Street over Tikr? That's Tikr. What would be your preferred software other than Tikr? Best free software in your opinion? Sorry for the tight ass question. Going through the value investor program currently, loving it, but can't spare the extra cash just yet for Tikr. So Tikr is a tool that costs about $20 US a month, and it gives you financial data on about 100,000 companies. So you can get it even does all the segment data. So different segments within a business. It gives you ratios, analyst forecasts, transcripts, all that sort of stuff. I think it's the best software you can get. It's only about $20. There is a free option for this Tikr. So there is a free option. Simply Wall Street is an Australian company built by Al and the team up in Sydney. It's a great platform. It's more focused on, I would say, newer investors, whereas Tikr is for more people that are really serious about their long-term investing. Both great, but I would choose Tikr for that type of investing. If you're just getting into it, you want to understand more, you can check out Simply Wall Street.
I've definitely preferred Tikr. I've tried both. I think Simply Wall Street has a 12-month subscription too.
Yeah.
It just gets a bit too, it's very algo and kind of, not gamified, but Tikr definitely pure data and easy to navigate.
Yeah, I love Tikr. But Market Index is what I use for announcements. That's just marketindex.com.au. Morningstar, you can get great analyst insights. It's got data as well. There's another one called Koyfin, Koyfin, another great one for charts and that type of thing. And I think if your brokerage account like Self-Wealth, if you use Self-Wealth, they have a lot of fundamental company data in there as well. So you can go in and even if you just create a free account with Self-Wealth, for example, you can go in and use that. So Phil writes in and says, and maybe it's pretty much the same one, but Phil writes in and says there was a second one there. There was a surname, but we won't read that one out. If I believe the Australian dollar is nearing its bottom against the US dollar, what stocks or ETFs can I buy so I profit when the Australian dollar does head higher and returns to 70 cents and above? Again, kind of what we just said. You probably think about it at a portfolio level, Drew.
Yeah, we tend to think about it. Basically, you're trying to find things that have hedged their currency risk and aren't unhedged. You're probably more worried about avoiding the things that have fallen significantly or what's going to benefit from a higher Australian dollar. That's generally people that are importing as well. If you think about import versus export businesses, export, I think loosely, sector-wise. And we'd always try to take. It's more about how do you minimize the mistake and the risk of that, less so on trying to profit specifically from sectors, because as we know, sectors can have idiosyncratic risks as well.
Oh, what a word! They can indeed. But
I used that in a meeting today too. That was fun.
It's probably acceptable in a finance meeting. Hedged ETFs you can use, which we've mentioned. You might, if you're thinking about things like gold, you might go the hedged option versus the unhedged option. We talked about currency frameworks just before, but one thing to keep in mind too is if you're investing in US companies earn money outside of the United States. So what that means is, I think we mentioned a couple of weeks ago about double whammies, and I said how if you invest in US companies and that share price falls, and then the Australian dollar falls, well, you're a two-time loser. Well, it's not always true, because what can happen to some US companies is actually when they have a very strong US dollar, it actually weakens their earnings. So when the US dollar falls, they earn overseas, which improves their US dollar earnings. So you can actually offset some of that. And so companies like, for example, Starbucks, companies like Nike, Apple, these types of businesses earn a lot of their revenue outside the United States. So they are cushioned a little bit from it. So that's something to keep in mind. And I would just say, all currencies around the world just about have weakened against the US dollar because the US dollar has such high interest rates. Sorry, go on.
It would depend on what's driving the Australian dollar resilience. Exactly. That also came to my mind.
Yeah, absolutely.
If the Australian dollar is recovering, it's probably because their interest rates gone higher, or US have cut their interest rates, or it's probably because of China, and that probably tells you more of the story as well.
Yeah. And you can repatriate some of your US dollars back to Australia and just start investing domestically again for a little while. That's actually a really good idea. Just be aware of fees and all that sort of stuff. So maybe we'll go these last two questions really quickly. So this one's from Supercalifragilisticexpialidocious. Says, I'm 21. I've been investing since I was 18. That's pretty awesome. I live in a low socioeconomic town in New South Wales. I have a few friends from school I still socialize with. They're great friends, but I try to distance myself from them as they do not align with my goals, beliefs, or values. They are not good with their money, and they often don't like to talk about savings or other strategies like investing. Most don't even have savings at all. They would rather spend it on nights out. I've become very passionate about investing in ETFs and the psychology around money. I crave stimulating conversations, which I can't seem to find with anyone my age in my area. Without my dad's help, I wouldn't have the motivation to keep on investing. So, how can I keep this drive alive without being influenced by my friends around me? It's a bloody good question, Drew. It's a fantastic question.
Well done.
Yeah. Yeah.
And you started earlier than I did, and probably earlier than you did too.
Yeah, absolutely. Yeah. And I just think, there's those old cliches. I'm the average of the five people closest to me, and et cetera, et cetera, et cetera. The fact is, you've actually made a decision to consciously look outside of your peer group. I was in a very similar situation. None of my family, none of my friends, no one that I knew personally really was interested in this stuff, except for actually one mate who eventually went down this path with me. But it took many years, and now they're all in their 30s. Now they're all coming asking the question. So this investing thing, should I start? Well, I've been saying it for 15 years, mate.
Don't be that guy.
No, but seriously, like, it's great when anyone comes at any age to have a conversation. Well, you're doing a great thing, I'd say, by listening to us. There are plenty of other good podcasts like Equity Mates, My Millennial Money, some of the US podcasts, but they won't really help you build community. You can come to our Sydney event, which I'd highly encourage you to do if you're in New South Wales. We're also in Port Macquarie. We'll be in Newcastle. So try and make the commute. The only reason that we do the events, get this, is so we can build community. There's no other reason. I can tell you why. These events don't make money. So there's that. But you can also join some online groups. Like, say, Equity Mates is a really good one. Just keep singling them out. But Equity Mates is a really good one. You can jump on Twitter. Twitter's a great place. If you want to work in the industry, jump on LinkedIn and start just commenting on what people are saying. You'll be surprised. And finally, as Steve Sammartino said on the show a few months ago, he said, change places. He had this rule of, if you want to change your life, change the place. And he had this example of, if you want to eat healthy, shop in the fruit and veg department, not in the aisle with all the chocolate. Like, literally change the place. If you want to speak with people who are healthy, go to where they are. They're probably at universities, or they're probably at business districts, or they're probably going to different venues. They're probably not going to the pub on a Saturday, for example. They're probably going somewhere else. So go and find those places and be there. I think it's awesome. I think it's a great thing you're doing. Finally, Drew, last one, which comes from Anonymous, too old to be entertaining. They've got. I'll break down.
I'm just trying to find a dad joke while we're here too.
Okay, you do that. While you're doing that, there was a person that wrote into us, Anonymous, too old to be entertaining, in brackets, said that they have two loans. They have a mortgage on their primary residence, but then they have an investment loan. And they said they phoned their bank a few months ago to see if the standard home loan could have a rate reduction. The answer was no, sorry, can't get a further reduction, even with the wealth package. And they'd been with this bank for 20 years. Fast forward a few months and phoned again with an offset account inquiry, and the fixed rate investment loan had rolled off onto a standard high interest rate. This is where things got interesting. Firstly, the person handling my call looked at our residential loan, went offline to the quote-unquote rates team, and came back and again said, sorry, no reduction on the 7.85% loan. I thought, bugger, that sucks. Not a great variable rate at all. She then answered my offset question around the investment loan and took that one offline to the quote-unquote rates team. Well, she must have got someone who was having a great day and was far more creative than the first person. She came back and said, I have fantastic news for you. We can lower that one from 6.9% to 6.3%, end quote.
It's massive.
And then huge, 0.6% reduction on the loan. She then also asked that person, can we do something for these people with 2 loans with us and a long-term connection on their residential home loan? And they instantly gave us a reduction from that 7.85% loan to 6.05%. I kid you not. I was stunned and very happy. I don't know how 1 minute for that loan, we were offered nothing, and a few minutes later got a 1.8% reduction. It happened. That is...
I mean, we're not all good at asking too. I know there's, if you go to a restaurant and something happens to your food, some of us just eat the food anyway. If you know what I mean. You have to be that kind of person that's willing to get no's. But as the case is, the worst thing that can happen is they say no.
Yep,
so why not? You're not going to be embarrassed. Might be embarrassed for like 10 seconds, but just ask.
Yeah, well, they can just say no, really. Think about all the things that they could say to you before you get nervous about it, and then just think about if it's worth it. I thought this was, they go on to say, I thought this was a really important lesson in these times, that persistence can pay. So if at first you fail, just try again. We just got lucky because I was calling them to sort out an offset problem. It's a lesson I will remember, and I hope it can help someone else. Love your podcast and ethos. Going to your Newcastle roadshow with my daughter. Thank you for all that you do to help people on their finance/life journeys, and good luck to Kate for her book sales. I really enjoy listening to her on the Australian Finance Podcast. That is right, folks. Kate's book, Buying Happiness, came out this week. I'm going to put a link in the show notes. Buying Happiness. It's out now on Amazon or Booktopia. Check it out. Buying Happiness. Support Kate. You will see copies flying around in Sydney, no doubt, if you come to the event, or Newcastle. Don't forget the roadshow. Don't forget the Waddle Partners retirement event on the 26th of October in Melbourne. It's a free event for anyone over 45 looking to retire, get advice on retirement. Come along. There is a link in the show notes. Check it out. Drew, we've got to leave, folks. You're the director of Waddle Partners Financial Planning. You're helping people all around the country, maybe even the world. You might find a client in New York City.
Never know. There's a few people from Australia here, a few advisors here too.
There you go.
Yep.
So, mate, you need to take us off into the distance. You need to give us a joke. You need to pep us up before we go off.
It feels like it was New York appropriate, but who knows? Dad says jokes as usual.
Okay, credit.
So 5 ants rented an apartment with another 5 ants. Now they're 10 ants.
Oh, gosh. I'll give you a 3 out of 10 for that one.
I should have said tenants, and then you wouldn't be. Yeah. That's right. I was on the fly.
That's well done, mate. Thank you so much for joining us. I know it's late over there in New York, but it never sleeps. So hopefully you can get a feed tonight. And we really appreciate you joining us, mate.
Good to see you. Good to be here.